What's up everyone, it's Scotty with MoneyVest. So today's video is going to be focused on volatility and the markets. I'm going to highlight some really interesting data and some analysis that's going to help you make some very good actionable decisions when it comes to managing your own portfolio. And you can actually think about this, of course, do your additional research and due diligence to see if it makes sense for your personal investment strategy as well. So hope you all enjoy this video and find it helpful. If you do, make sure that you drop a like. That's all I'm asking in return, is that you drop a like and subscribe to the channel. Again, link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only private videos. And you can even check out all of our spreadsheets, including my fair values, my watch list, and 20 plus Discord channels where I'm sharing and sending out all the alerts related to what stocks I'm buying, what trade ideas I'm looking at, and of course a lot of other benefits, including being able to engage with over 1,200 members worldwide. These are all very successful, very wise traders and investors that have a lot of years of experience collectively and are managing a ton of money. So again, link's going to be down below if you want to join and connect with all like-minded individuals, and of course grow your portfolio, and of course learn and understand fundamentals, technicals, macros, and options as well. Everything's going to be covered with the link down below. And also do connect with me on Instagram. I do post a lot of interesting stories, behind the scenes stuff, and portfolio updates and whatnot. So my handle is going to be CastWRP. Definitely do connect with me there, and we'd love to have you on board over there as well. So when it comes to volatility, now volatility is, in my opinion, itching to start trading back higher, or basically starting to see a little bit of that momentum back up. And in fact, we are trading at a level right now which we haven't seen since November of 2023. So it's been well over 3 to 4 months since volatility has traded back up to 14.5, and that's exactly where we are at the moment. Now, we have talked about how VIX has been pretty low for a very long time. Of course, this right here was a spike during COVID when it traded all the way up to 82, 83 levels. And in the last several years, we've seen multiple spikes up to 36 and 40. And then, of course, multiple spikes up to 20, 18 levels. And now, more recently, it's been kind of trading at these really low levels, which we haven't seen since before the pandemic, right? So before the pandemic, it was obviously 11 and 12 until finally seeing a very significant spike on the back of the COVID pandemic. Not saying that we're going to see something very similar, but of course, we got to be super careful and cautiously optimistic, kind of really understand where the risk reward is. Because in my opinion, I think volatility is something that is really underrated from an indicator standpoint, because the win rate is so good. It's so freaking good. If you simply just look at the volatility as a buy signal for every time we see the VIX going up, and kind of using that as an indicator to basically dollar cost average or buy, it has given you some very good sort of analysis. So if you come over to the next screenshot, this right here, I basically pointed out over the last 3-4 years, every time the volatility has seen a pretty reasonable spike, we have seen, of course, the S&P 500 that has represented a very good buying opportunity for the volatility. Of course, this right here was the pandemic in 2020. This right here, another buying opportunity. This right here, yet another buying opportunity, dollar cost average into. This right here, again, the market's consolidating sideways. This right here, again, December 2021. Now, this right here was the beginning of the bear market. So what we really witnessed was consistent lower highs. So I'm not saying that volatility is the only measure to be looking at. Of course, we need to have an understanding of the overall technicals as well, because this was a very clear downtrend where the markets, of course, continue to trade lower and lower, making lower highs and lower lows. So every time we were dollar cost averaging, let's say, at these levels, once over here, second time, and third time, yes, the markets continue to trend lower. So there was an unrealized loss on the books, but eventually, of course, they all ended up being very solid, good buying opportunities, because not only did we see a short-term reversal, as you can see over here, eventually the markets did recover really well in 2023. So the bottom line, the idea here is to really use this as a gauge for better understanding of the risk and reward, and where is the optimal timing wise, and of course being more efficient in terms of understanding where dollar cost averaging is going to make a lot more sense. This right here, again, another opportunity. Every circle that you see on the S&P chart is correlated with the time when the volatility was higher, when it actually did spike and was actually pushing higher. I'm going to actually share a few other indicators to follow along with, because they don't give us the buying opportunity every single week or every single day. There's very few times when we get that. And when we get that, that's when we need to take advantage. That's when we need to finally start dollar cost averaging into it, because the window is going to be very, very small. I mean, take a look at all these weeks here. It gave us maybe 2, 3, 4 weeks to dollar cost average into before the market started rallying back up and volatility started dropping back lower. Now, another thing to keep in mind is the 10-year treasuries, right? The yields have been pushing higher. They've kind of consolidated sideways. They've stabilized a little bit, just over 4%, and they're now moving back upwards. And this right here is the range within which I've mentioned before in my previous videos, where I could see the volatility kind of stabilize a little bit, unless of course inflation starts to reaccelerate back higher. If it starts to reaccelerate back up, that obviously creates that dynamic where the Federal Reserve is going to be a little bit more resistant in cutting rates, and as a result keeping rates higher for longer, and that obviously is not going to be great news for the market, considering what we have already priced in. As many as 7 rate cuts are being expected and priced in from the market right now. So of course, interest rates, very, very important indicator for driving markets, and this is going to be that inversion of the yield curve where we did see, of course, the spread between the 10 and the 2-year come down to negative territory and, of course, be negative. And now we're starting to see that momentum back up. So we're seeing that uninversion process takes place. And as that uninversion takes place, of course, we've seen that recession. We've seen recession in the past. We've seen the market drawdowns in the past as well. And this right here, yet another really important indicator to keep in mind for when you are looking at dollar cost averaging opportunities. So every time, of course, this indicator is above in that red zone, that's going to be in the 90% level. That's a percentage of stocks trading above their 20-day moving average. We have seen the markets pull right back down. And this is going to be the 50-day moving average. Once again, every time we're kind of inside this red rectangle, the markets have given us reason to be cautious from a risk reward standpoint. But every time we come down to these green rectangles is a time to really be super cautious in the markets. So my playbook is very simple. I'm only watching 5 technical indicators, and these are the indicators in the order of priority that tell me to start dollar cost averaging into and start basically that buying process. Okay, so not going to overcomplicate things for you. I'm going to keep it very, very simple. The moment I start to be a little bit more aggressive and start buying and dollar cost averaging into the market and start deploying more cash is when the VIX trades back up to over 20. S5TW is less than 6. This is percentage of stocks that are trading below their 20. Percentage of stocks that are trading below, they're above their 20-day moving average. So 20-day moving average, if it's under 6%, meaning 94% of stocks in the S&P are trading below their 20-day moving average. That's a very, very oversold market. This right here, S5FY, that's going to be percentage of stocks that are trading above their 50-day moving average. If it is below 20%, that means 80% of stocks are trading below their 50-day moving average. The RSI on the S&P 500, the daily RSI is less than 30. That again is going to be a pretty oversold market. And this is going to take some time. This doesn't happen very often. But the moment the S&P is down 20% from all-time highs, that is a bear market for the S&P, and that again, like I said, doesn't happen very often, but if it does, that's only happened 17% of the times in the last 75 plus years. So 83% of the times the markets are within 20% of their all-time highs. So also a very, very rare occurrence in the market when it is down a little bit over 20% from all-time highs. So that's the playbook. In the meantime, of course, we are nowhere near close to 20 RSI. This indicator is nowhere near close to 6. This is nowhere near close to 20. RSI is over 61. Markets are pretty much near all-time highs. So what am I doing right now? Not buying. Exactly the opposite, right? Not dollar cost averaging aggressively. Sure, I would be interested in maybe dollar cost averaging into like a broad-based ETF regularly, VUG or SMH, because as I've mentioned before, the markets have the tendency to continue to drift higher, right? Timing these drops, timing these sell-offs is incredibly difficult. That's exactly why it's our job to never predict. These are just indicators to watch for the next time. The next time this happens, we are ready to start deploying cash and start buying aggressively and dollar cost averaging into the market. I just don't want you guys to be scared or be afraid for when that happens. So this is exactly our playbook, and these are the most important indicators that I like to watch closely when I'm looking at risk reward ratios, looking at dollar cost averaging opportunity, looking at the window for buying. So, and again, all the alerts will be sent out in the Discord. All the updates will be sent out in our community. So again, if you want to join, link's going to be down below. Let me know your thoughts down in the comment section below. And again, I'd love to have you on board as a MoneyVest member. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, keeping it super simple, not going to overcomplicate this at all. And just watching these very specific indicators for us to better understand what's the perfect timing and, of course, optimal efficiency wise, when's the right time to be deploying cash a little bit more aggressively. So as always, happy investing, and I'll see you all in the next video.